Today, we will talk about stock market for beginners, a step-by-step guide. Investing in the stock market can seem like a daunting task, especially for beginners. However, with the right knowledge and approach, it can be a powerful way to grow your wealth over time. This step-by-step guide is designed to help you navigate the world of stock market investing, even if you're starting with little to no experience. Understanding the stock market. The stock market is essentially a marketplace where buyers and sellers come together to trade stocks, which represent ownership in a company. When you buy shares of a company, you are buying a small piece of that company, becoming a shareholder. The stock market is made up of several exchanges, such as the New York Stock Exchange, NYSE, and NASDAQ, where stocks are bought and sold. Each time a company wants to raise money for expansion or other purposes, it can issue stocks to the public through an initial public offering, IPO. After the IPO, stocks can be bought and sold on the exchange. The price of a stock is determined by supply and demand. If more people want to buy a stock, its price rises. If more people want to sell, its price falls. It's important to note that the stock market is inherently risky, and stock prices can fluctuate dramatically based on company performance, economic conditions, and broader market trends. Learning the basics of stock market terms. Before diving in, it's crucial to understand some basic terms that you will encounter frequently in the stock market. Stocks or shares represent a portion of ownership in a company, and when you buy stock, you become a shareholder. In addition to stocks, there are other types of investments you may encounter, such as bonds, which are essentially loans you give to companies or governments in exchange for interest payments over time. Markets also experience periods of growth and decline, commonly referred to as bull markets, when prices are rising, and bear markets, when prices are falling. Understanding these basic terms will give you a solid foundation for making informed decisions. Defining your investment goals. Before you start investing, it's important to define your investment goals. What do you want to achieve with your investments? Are you investing for long-term growth, like saving for retirement? Or are you looking for short-term gains to fund a specific goal, such as buying a home or paying for a vacation? Your goals will guide your investment strategy. Knowing your risk tolerance is also key when setting goals. Risk tolerance refers to how much risk you are willing to take on in exchange for potential returns. Younger investors with long-term goals typically have a higher risk tolerance because they have time to ride out market fluctuations. Older investors, on the other hand, may prefer safer investments to protect their savings. Choosing a brokerage account. Once you've set your investment goals, the next step is to choose a brokerage account. A brokerage account is necessary to buy and sell stocks. There are different types of brokers available, including full-service brokers, discount brokers, and robo-advisors. Full-service brokers offer personalized advice, research, and portfolio management, but they tend to charge higher fees. If you prefer a hands-on approach and want to make decisions independently, a discount broker might be a better fit. These brokers offer low-cost trading platforms, which allow you to buy and sell stocks at a lower fee, but they typically don't offer personalized advice. Robo-advisors are automated platforms that help manage your investments based on your risk tolerance and financial goals. These platforms are ideal for beginners because they create a portfolio for you, making investing easier and more automated. They are generally low cost and offer a hands-off approach to investing. Starting to invest. Now that you have a brokerage account set up, it's time to start investing. The process is relatively simple, but it's important to take a thoughtful approach. The first step is to deposit money into your brokerage account. Most brokers allow you to link a bank account to transfer funds electronically. Once your money is in your brokerage account, you can begin buying stocks or other investment assets. You will also need to decide whether to purchase individual stocks or invest in a broader basket of stocks through mutual funds or exchange-traded funds, ETFs. Mutual funds pool money from many investors to invest in a diversified portfolio of stocks, bonds, or other securities. ETFs are similar but trade like stocks on an exchange. Both mutual funds and ETFs can help you diversify your investments and reduce risk. Diversification. Don't put all your eggs in one basket. Diversification is one of the most important concepts in investing. The idea behind diversification is that you spread your investments across different asset classes to reduce the overall risk of your portfolio. For example, instead of investing all your money in a single stock, you might choose to buy stocks in different sectors, such as technology, healthcare, and finance. You might also invest in ETFs, which provide instant diversification by holding a variety of stocks in a single investment. By diversifying, you protect yourself from the risk of a single company or sector performing poorly. Diversification can also help smooth out the ups and downs of the market, as different sectors and industries tend to perform differently in various economic environments. Managing your investments. After you've made your first investment, the next step is to manage your portfolio over time. Successful investing requires ongoing attention to the performance of your investments and adjustments as necessary. It's important not to panic during market downturns. The stock market can be volatile, but long-term investors are often rewarded for their patience. Regularly review your portfolio to ensure that it remains aligned with your goals. If necessary, you can rebalance your portfolio by buying or selling investments to maintain your desired asset allocation. It's also important to keep up with market news and trends. Understanding broader economic factors, company earnings reports, and geopolitical events can help you make more informed decisions about your investments. Staying long-term focused. The stock market is a long-term investment, and the key to success is staying focused on your goals. While it's tempting to check stock prices frequently or try to time the market, research shows that long-term investors tend to outperform those who try to make quick profits by buying and selling based on short-term fluctuations. Over time, stocks generally rise in value, but there will be periods of volatility. Staying calm during market fluctuations and sticking to your strategy is essential to achieving long-term success. What do you think of our video? Let me know in the comments section below. Also subscribe to our channel before you go. Thanks for watching.